Good day. There seems to be no end to inflation and global interest rates being the main topic of investment discussions. I think the following chart probably warrants it being the talk of the town. It illustrates the extent of the Fed's current hiking cycle over the past 25 years, which has been the most aggressive in over 40 years. But why does the United States Federal Reserve Bank's interest rate policy matter to us at the most southern point of the African continent? Firstly, capital flows. When US interest rates are high, it can attract foreign investments into the United States at the expense of emerging economies like South Africa. With our dependence on foreign direct investment, we are effectively always looking to posture in a place where returns of investing in SA are as attractive as possible, so we adjust interest rates accordingly. This can make it more expensive for South African businesses and individuals to borrow, and it makes it challenging for South African importers to compete due to the increased cost of goods. Secondly, exchange rates. Changes in US interest rates can also affect the exchange rate between the US dollar and the rand, impacting inflation and economic growth in South Africa. Generally, when interest rates increase in the US, it can make investing there more attractive due to the higher return against a lower risk. The increased demand for the US dollar causes its value to rise relative to the rand and other emerging economic currencies. This results in a higher exchange rate for the rand against the dollar. Now, doesn't that sound familiar? On the other hand, when interest rates in the US decrease, the higher South African interest rate becomes more attractive, which can increase demand for the rand, and it causes its value to rise relative to the dollar, resulting in a stronger exchange rate for us. It's also worth noting that other economic indicators such as GDP, inflation, trade balances, and political instability also affect the exchange rate. However, interest rate differentials between the US and SA can significantly determine the exchange rate between the two currencies. Now that we have a better understanding of how the rates are related, what are the implications for the different asset classes from a multi-asset investment perspective, like a focus range of model portfolios and fund of funds? Interest rates and bonds have an inverse relationship. When interest rates rise, bond prices fall, and vice versa. Newly issued bonds will have higher coupons, which is the annual income an investor can expect to receive while holding a particular bond after rates rise. This will make bonds with low coupons issued in the lower rate environment worth less than newly issued bonds at higher rates. From an equity perspective, it's not quite so straightforward. But suffice to say that higher rates means that less money is available for consumer spending and business expansion, affecting the earnings outlook for businesses. Present value calculations of future earnings for stocks are tied to assumptions about interest rates, affecting valuations. Higher rates will reduce the present value of future earnings for stocks. When this occurs, stock prices tend to face more pressure. We can see that interest rate fluctuations can affect investments in different ways. The opposite to the above also applies in a decreasing rates environment. So we can start to understand why the when in interest rate discussions is so topical. Turning our attention to how this played out in the last quarter, hawkish central banks and signs of moderating growth drove both local and global equities down further during September. They recorded their worst month and quarter so far this year. Local equities were down by 3.5% and globals 3.6% in rand terms during quarter 3. Furthermore, sticky inflation and the associated likelihood of interest rates being higher for longer resulted in a sell-off in both local and global bonds. The yield on the US 10-year Treasury is now trading at its highest level in 17 years as at the end of September. Local bonds ended the quarter down 0.4% and global bonds delivered negative 4.5% in rand terms. September was also a difficult month for the listed property sector, as it was down 4.1% for the month, 1% for the quarter, with tough debt capital markets weighing on corporate earnings. Cash returned 2.2% for the quarter. It is worth noting that all returns are still positive over the last 12 months. The rand weakened by 0.4% against the dollar over the quarter, After a short bout of strengthening during July, it's down 4.6% over the last year as at the end of September. Well, the simultaneous fall in equities and bonds over the third quarter will remind many investors of 2022 there were some important differences in the drivers behind these moves. Economic data over the quarter pointed to a deterioration in the growth outlook. If we continue to see moderation in global inflationary pressures, we can perhaps start to feel more confident that we are indeed approaching a peak in the global hiking cycle. Don't expect rates to start coming down too soon, however, as the higher for longer approach that major central banks are expected to follow is also likely to be adopted by the SARB. There is light at the end of the tunnel, we just don't know how long the tunnel is. The above highlights that there are no one-hit wonders or crystal ball solutions when it comes to investing. That is why it is important to stay invested and to stay focused on long-term investment objectives. Provided there hasn't been a change in circumstances, sticking with the original plan and making use of a well-diversified multi-asset solution with exposure to all the different asset classes is the only recipe for long-term investment success. The MFP focused model portfolios as your bespoke multi-asset DFM solution managed by Equilibrium, as well as the Momentum Focus Fund of Funds does exactly that. Returns for these solutions were negative for the quarter, with nowhere to hide, as the negative returns from all asset classes as discussed impacted short-term performance. All of the funds performed in line with their respective peer groups over the quarter. Returns over the last year and longer periods are also still very much in positive territory, giving double-digit returns in line with the respective peer groups. It is quite normal to see slightly more volatile short-term numbers from both these sets of solutions, as we stay invested aligned with the time horizon and objectives of the solutions. This increases the probability of long-term investment success. MFP Focus 3, 5, 7 and 7 unconstrained were down by 0.78, 1.82, 2.25 and 2.36% for the quarter. The Momentum Focus Fund of Fund delivered negative returns of 1.41, 2.40 and 2.90% for Focus 3, 5 and 7 respectively. Due to time constraints, the numbers have not been finalized yet, so there can be a slight difference to the official numbers that will be published on the September 2023 fact sheets. Please refer to the fact sheets once they are published for September for more information.